Let's start by doing a quick reset of where things stand in the financial markets in terms of risk. Stocks hit new all-time highs on Thursday, but long-term treasuries are also up around 5% over the past 3 months, as bond yields still aren't moving higher. Lumber prices have fallen 50% from their peak earlier this year. Other commodities, including copper, corn, and wheat, are also seeing their prices plummet off of their highs. Utility stocks, however, still aren't seeing the bump that I expected, and small caps are leading on the way up during this latest recovery rally. With 2 of my signals at risk on and 2 at risk off, this feels like a fairly accurate representation of current market conditions. We also know that the Fed is unlikely to raise interest rates for another couple years, although they'll likely taper bond purchases earlier than that. Most of the market is pricing in the fact that inflation will return to normal within the next 12 months or so. As we know that the large majority of market watchers and analysts are expecting gains in the stock market to continue. US stocks keep shaking off any potential bad news to keep driving higher, but treasuries are telling a different story. The 10-year note is roughly 30 basis points below its March peak, indicating there's some degree of worry among investors who are seeking out safe havens. Equities have been mostly impervious to smaller risk events over the past several months, but what about a large risk event? The proverbial black swan that could catch the markets off guard and send risk asset prices reeling. I think we could be facing such an event just 1 month from now. July 31st is the date that the US government will hit the debt ceiling. In theory, that will be the date that the US government could no longer borrow new money for operations. Without the ability to raise new capital, the government could miss or reduce interest payments on existing outstanding debt, resulting in a credit default that would irreparably damage the reputation of US sovereign debt. Historically, Congress has always elected to simply lift the debt ceiling, but there are indicators that there could be a fight leading up to the July deadline this year. As most of us know, the US political environment has become highly partisan. Following an unprecedented increase in the federal debt over the past few years, which has included corporate tax cuts, numerous stimulus and consumer relief packages related to the COVID pandemic, and a potentially new infrastructure package on the new way, a new battle could emerge over limiting new debt issuance, cutting spending, or both. We'll keep the political arguments out of this and focus only on the possible outcome of a debt rating downgrade or an outright default. Like this video and want to learn more? Check out the full analysis of this subject and anticipate stock market corrections and volatility using award-winning research. Sign up at www.leadlagreport.com and join the Lead Lag Report for 2 weeks free and 30% off with promo code YouTube30.